Okay, this week's outlook, which obviously will be following up last week, which was very hectic to say the least. We saw the Sell America trade materialise into a massive dollar sell-off. Um, we've seen metals do extremely well. Big correction on Friday, but metals have done extremely well. So yeah, coming into this week, we'll obviously go over all different currencies, what we're looking at, and then we'll do technicals at the end as usual. So, starting off with the calendar for next week, we have on Monday some ISM data coming out of the US, forecasted to come in slightly better than usual, well above the previous reading. We then have Bostic speaking in the evening. Obviously, eyes will be on yields for this. Tuesday, we then have the RBA rate decision with a forecasted hike of 25 basis points, which is very, very, very important, which we'll go over, and could lead to a sort of buy the rumour, sell the fact sort of narrative. And then obviously the press conference will be heavily watched to decipher whether we're more hawkish from here, etc. Jolts is then expected to slip a bit in the US on Tuesday, which could bleed into some lower yields and a lower dollar. Wednesday we then have inflation and estimations in Europe, which are forecasted to drop a bit. However, core inflation is expected to remain the same at 2.3%. That's about it for. We have services PMI on Wednesday as well, which is forecasted to slip a tiny bit. Thursday, we obviously have the Bank of England rate decision, where a forecasted consensus is a rate hold, and we believe the same. The vote split is going to be very, very important. So previously it was at five for a cut, 4 for a unchanged for a hold. This time I believe it's seven for a unchanged, 2 for a cut. But that'll be interesting. Then also on Wednesday we have the ECB, so quite a busy week central bank wise. We have the ECB on Thursday. They're expected to hold rates as well, and Lagarde's been hawkish as of late. However, it's a very data dependent approach from the ECB. It's very much, is the data doing well? What's the data saying? All right, and you can literally measure that just by looking at the European 2-year yield, and that will tell you where the economy's heading. Friday, we then have the big NFP forecasted to actually do quite nicely for the US, which could end the week on a high for the dollar, which we think, we'll go over this into more detail obviously, but we think coupled with the new Fed chair, coupled with the massive sell-off last week, and now we're decoupling from rates, there almost needs to be a sort of pullback, and we think this week could be good for a pullback for sure. And then we have the Canadian labour market data on Friday as well, same time as NFP, which is forecasted to stay pretty flat. Not a massive change there. So yeah, this is everything we're looking at for this week. So going into the individual currency analysis, starting off with, of course, the US dollar. Neutral is what we are on the US dollar, because we've got a lot of factors pointing to downside, like the Sell America trade, but then you have other factors geopolitically pointing to upside. For instance, last week's late week bounce in the dollar reflected relief from the violent unwind in precious metals and reduced tail risk after Kevin Walsh, obviously, as we mentioned, was put forward to lead the Federal Reserve. But this was more a positioning reset in our eyes rather than a genuine shift in the outlook. The pressure on the dollar now comes from structural diversification into the euro and the latent risk of sharp yen appreciation tied to, obviously, Japanese political and equity dynamics. Yield-wise, we've had a slight retracement regarding data this week. It's rather mixed with a strong NFP but weaker jobless claims and ISM data at the start of the week. On the other end, similarly to 2025, the Sell America trade has already gone into reverse. You have the US government shutdown risks fading, and you have geopolitical risks centered around Iran, which could boost the safe haven appeal of the dollar. However, as of now, we see no catalyst for further dollar upside or downside. It's almost like we're forecasting a sort of consolidation, which is obviously great for the hedgers. So yeah, that is essentially everything on the dollar front. Sentiment is pretty neutral. The labour market seems to be improving. I mean, unemployment in January has gone down 20 basis points. NFP, slight correction, but we're still hovering around the 50,000, 60,000 mark. Inflation, pretty core, has fallen to 2.4%. However, CPI itself, year over year, is maintaining at 2.7%. So yeah, and going into February, it's a pretty neutral month, seasonal wise, for the dollar. And if you look at yield reactions here, you can see that the last FOMC was pretty neutral. GDP was a hawkish print, unemployment claims was a hawkish print, NFP was a hawkish print, CPI was more neutral. So yeah, we're not getting many dovish prints, which could lead us to see another hold in March. And then insights wise for the dollar, we'll go over these, but essentially they're coming out. It's pretty neutral as well. I mean, you've got SocGen here saying sell the euro, pound and dollar, so obviously dollar bearish. Whereas you've got ANZ saying into FOMC, we're obviously bullish, and then coming out of FOMC, we're bullish. Like Credit Agricole are bullish ahead of next week's ECB meeting. JP Morgan are bullish against the yen. So yeah, it's definitely a contradicting pair at the moment, the dollar. I mean, everyone's pretty neutral. You've got factors for upside and factors for downside, which is why we're forecasting consolidation. However, that does not mean we're not going to trade it, as you'll see in the technicals section. Going into the pound then for this week, we remain bearish. However, we could see a slight pullback to the upside off the open just due to the metals correction. Obviously, you've now got money flowing out of commodity currencies. It's now going to be going into more less commodity based, so euro, pound, etc. With the Bank of England decision being the primary focus this week and a hold being consensus, data remains weak. I mean, unemployment is at a 5-year high. The unemployment rate is at a 5-year high, 5.1%, which is just mental. COVID levels, to be exact. GDP is sluggish and inflation is on a downwards trajectory, as you can see here. I mean, ING even mentioned in one of their reports, if I could find it, they mentioned how they see... I don't think it's here. No, it's not here. But I was reading a report where ING are basically saying they are expecting downside in inflation in the UK. They're expecting it to reach 2% by April, which is quite mental considering we're right now at 3.4, 3.2. Regarding the Bank of England, the ongoing tension inside the Bank of England leaves markets without a clear policy narrative. So I'm not sure if you've noticed, but there's a lot of division inside the Bank of England, which obviously is not good for politically wise, and it's not good for a sense of direction. So as a result, you're seeing like the 30-year yield creep up, which obviously signals a bit of tension, and this is obviously not good news for the pound. So yeah, that is essentially the pound. BNP Paribas are basically saying that if we go into insights here, we can actually scroll down and have a look at the pound. Here, BNP Paribas warns of pound vulnerability as yield support erodes. Obviously, give it a pause, you could read that. Same thing here with Goldman Sachs, they're bearish on the pound. Same thing here with the SocGen. So consensus among institutions for the pound is very bearish. Bearish. UBS are bullish. However, it's on pound dollar, which in our opinion is a weak versus weak pair. So yeah, consensus is very bearish among institutions on the pound, which is obviously everyone's looking for downside. Moving on to the euro. So this week for the euro, I am bullish, but on specific crosses. So by this I mean you want to pair the euro up with specific pairs. You don't want to trade the euro against the Swiss franc. You want to trade it against the pound. You want to trade it against potentially the yen. So yeah, Regarding this week's data, we have the ECB on Thursday, as mentioned, where rates are forecasted to remain at the 2.15% handle. Short-end yields over the last few weeks have gradually been drifting lower. However, structural flows will persist following the diversification flows as reserve managers and long-term allocators reassess dollar and commodity allocation. Obviously, I'm saying this because we had a massive pullback in commodities on Friday. So you're going to see some money start to flow out, because if money's being pulled out from commodities, it's going to go into other sectors, we should say, and the pound, Europe, those are two currencies that are not commodity currencies. So yeah, yield reactions out of Europe, as we've mentioned, Lagarde's been pretty hawkish as of late. December ECB was hawkish. Yeah, I mean, inflation's sticky, for sure. So yeah, that's that. What are the institutions? They're for the majority, they're quite bullish. I mean, Crédit Agricole are a fan of euro. BNP, as mentioned, are a fan of euro pound, same as Goldman. So yeah, that's that. Looking at the CAD now, not as many insights this week, but short-end yields in Canada remain to hover. So yeah, we're bullish on the CAD, as I mentioned. Short-end yields in Canada remain to hover around the 2.5% level, giving the Canadian dollar some support from a rate differential standpoint. More importantly, though, we are seeing US oil breach the 65 handle, following geopolitical tensions between the US and Iran. These flows will support the CAD, as obviously the CAD is a commodity currency. US oil has not been hit like gold has. The data is remaining supportive of rates staying on hold, with hikes forecasted further down the year. And the data forecasted this week, which obviously is the labour market data, is forecasted to come in at the previous reading, which shouldn't sway the markets much going into the print. What I mean by that is we shouldn't see the markets heavily price in this print, because it's a non-event. It's quite sticky. So yeah, not much has changed data-wise, is what that basically means. And then, as you can see here, Bank of America, this was from last week, just saying how they expect the Bank of Canada to hold their base rate at 2.25%, which obviously was the case. So yeah, that is the CAD, bullish on the CAD. Now if we look at the Australian dollar, and we'll do the New Zealand dollar as one as well. So obviously we'll put these two together. Australian dollar and New Zealand dollar. Well, we are bullish on both, and due to a combination of supportive factors. So for one, commodity dynamics. Although we've had a pullback in gold, and we're going to see some diversification, you have to remember that this was the fundamentals for gold haven't changed. Upside is still forecasted, which is obviously we'll go over when we talk about the Swiss franc. But yeah. So yeah, improving risk sentiment is another factor, and then dollar weakness, with both currencies, AUD and New Zealand dollar, offering exposure to global growth without the political and institutional baggage affecting the US and Europe. Equities remain stable, and the Chinese yuan continues to appreciate. Data-wise this week, we have the RBA, who are forecasted to raise the RBA's base rate by 25 basis points. Obviously, apart from them, the Bank of Japan is the only other central bank raising rates at the minute. Following this, we could see a buy the rumor, sell the fact reaction, which will give us further opportunities to get in for AUD upside. What by that I mean, off the initial rate hike, a lot of people obviously think, oh, rate hike, buy the currency. However, because this rate hike has been priced in, is consensus. If they do raise rates, you could see actually a pullback in the Australian dollar, as we have a lot of investors taking profits, and then that will just give us a better opportunity to get in for further upside. The labour market data coming out of New Zealand this week is set to be unchanged from the previous reading and shouldn't sway markets that much leading up to the print. Similarly to the CAD, yeah, we should not expect that much different. Bank of America, as you can see here, we expect a hawkish hike at next week's RBA meeting on Feb the 3rd. SocGen are saying buy the AUD. Crédit Agricole are saying sell the pound against the Australian dollar. So obviously they're long AUD. RBC, 3 reasons to stay bullish on the AUD. So obviously consensus among institutions is Australian dollar bullish. And then even if you look at yield reactions, January's labour market data was quite hawkish. Jan CPI, the initial reaction was actually dovish. However, it's now been priced out as hawkish. So yeah, and then I mean, even if you just look on the recent news here, you can see from Bloomberg, Australian dollar bulls pile into options as rate hike bets grow. Australian business activity picks up in December. Core inflation tops forecast. Stokes risks of a rate hike. I mean, this is all recent, 2 days ago, 4 days ago. So yeah, everything is looking pretty supportive of a rate hike, which is great for the Australian dollar. I mean, if you scroll down here and you look at inflation, I mean, 3.6%. We haven't been this high in a good number of months. Unemployment rate is at 4.1%, fallen by 20 basis points. So on paper, you've got a labour market strengthening and you've got inflation rising, which is obviously great for the Australian dollar. New Zealand wise, inflation's on a bit softer. However, the New Zealand dollar itself is driven a lot by rate dynamics and China flows, which obviously we know are doing great. So yeah, UBS bullish on the NZD, ANZ are bullish on the NZD. Looking into the Japanese yen, a very controversial pair at the minute. But essentially, I'm bearish on the yen this week due to, but you have to be aware of intervention risks. They could intervene any minute. We know what they're like. Following last week's comments from Scott Bessent, where he outlined the fact that the US will not be intervening to support the yen, we saw the yen drift lower, and for good reason. It's essentially, the markets do not expect one-sided yen intervention to be effective. And by one-sided, I mean, the markets don't think Japan, being the only ones intervening to support their currency, is going to be as effective as if the US did. So obviously that makes sense. So we're going to see a bit of pricing out of intervention, which is why we saw a nice pullback in yen. Since then, Goldman Sachs and JP Morgan have both reinforced that move, stating that they are tactically bearish on the yen, which we'll go over in the insights. However, intervention risks still persist. You do have to be careful, but with official support rhetoric cooling and bank desks aligned with our view, we've turned more bullish on UJ in the short term, and then also NJ and EuroJ I like the look of. Obviously we'll go over that. So yeah, insights, if we go over here and we look at JP Morgan here, if expectations for coordinated intervention fade, dollar yen could return to the 158s, meaning the 158 handle on dollar yen. This is obviously bullish on the dollar, bearish on the yen. Similarly, Goldman Sachs here, that was JP. Goldman Sachs here are basically saying we remain cautiously bearish on the yen tactically. Overall, we remain cautiously bearish and see risks skewed to the upside on our dollar yen forecast path, Goldman Sachs adds. So yeah, that is consensus there for the yen. Finally, moving on to the Swiss franc. We are bullish, which obviously might come to a surprise due to the gold sell-off. However, if you even look at the gold sell-off and then the impact it had on Swiss franc pairs, it's not that big, which indicates the market is expecting is expecting gold to bounce back, obviously then indicating the Swiss franc will bounce back. So yeah, I mean, for us, essentially the Swiss franc continues to attract inflows as geopolitical tensions and questions around institutional credibility keep investors on edge or uncertain. While the recent pullback in precious metals has stripped out some speculative momentum from hard assets, it has not altered the core reasons investors turn to the Swiss franc. Obviously, those being political neutrality, financial stability, hedge against inflation, a reliable store of value. These are just a few. And in our view, the underlying fundamentals remain intact. A potential rebound in gold early next week would likely reinforce this dynamic and leave the franc positioned to grind higher. So yeah, still bullish on the Swiss franc. Not much has changed. We're just going to get a nice pullback to get in at cheaper prices. So yeah, that is that. Now, if we come over to TradingView, where we go over our watch list for this week, let me share my screen to if it wants to let me. Perfect. Perfect. This should be good. If I make this full screen. Perfect. We'll go over this. Okay. So yeah, starting with the DXY, I'm expecting a nice pullback. I know we mentioned that we would potentially move a bit higher. However, I do definitely want to see a pullback to 96.5 could be nice. I want to see a pullback into this sort of region. So I think a bounce off here in these candles, come down, could be nice. Going on to dollar Swiss franc. Obviously this would make sense with the whole narrative. So yeah, I would like a bounce here. Potentially capitalise on that from the Swiss franc flows and gold rebounding on Monday. I think this would be good. Play a bit of mean reversion to the 0.77 handle. Getting off the 0.75. And if I just mark this handle out here. Yeah, I like this handle here for a nice bounce. Could even be more aggressive on the stop. Play something like that. But yeah, Swiss franc against the dollar, that's what I'm looking at. Pound AUD. So, I really like this level here on the 4H. It looks very nice. Maybe even the 8 hour. 1-8. Yeah, regardless, I really like this level. Managed to catch a lovely short on Pound AUD last week off this nice level here, 197. I think the 197.5 is a lovely level to bounce. Fundamentals remain intact. So yeah, that is essentially what I'm looking for on Pound AUD. Similarly, Pound CAD, I do like that level there. My only concern is I think we might just melt off the open. But I do like this level here for something like that. I'm not in this, but Pound NZD essentially the same as let's get rid of that. Basically the same as Pound AUD. I like coming to that level down. 2 hour zone. 2.29 handle is essentially what I'm looking at. Can definitely go more aggressive on the stop, 100%. Pound Swiss, same thing here. I think this level is beautiful. The 106.25. Yeah, 106.25 looks lovely. I'd probably have my stop above this. So if I was to get into this, I'd want to get in around here. Stop probably at the 106.5. Targeting a 1-to-1. Yeah, something like that. New Zealand dollar against the US dollar. This is very, very nice fundamentally. I'd probably just want to wait till we get into some level around here before we get a bounce. Something like that could be lovely. Something like that could be beautiful. AUD USD, same thing here. We've got it marked out. Euro pound. Now this is a very tricky one because if we do come down into this level, I'm buying every day of the week, 2% risk because I'm very confident in this level. However, if we even just go on like the 1 hour, you can clearly tell here it loves this level. You've got a bunch of algos at this level, and as soon as we come into it, you just see buy orders tick off. It's just like so. This could be a nice play. If it does happen, I think it will be off the Sunday Open and I won't get tagged in due to spread. But this could be nice for a bit of mean reversion. Euro dollar. I mean, I'm not really looking to trade euro dollar, to be honest, just due to it's a strong versus strong. But obviously the opposite of the DXY, so maybe something like that. And then pound dollar, I think this could be lovely. I know it's a bit interesting regarding, oh, what? I thought you were bearish on the pound and neutral on the dollar. This is a very statistical play. But I think we could see a bounce here. I mean, bit of mean reversion. Bounce off the 365, 3675 even. So yeah, I believe that's everything. Oh, euro yen, of course. And then the yen pairs. So yen pairs, I want to see a bounce. Something like this. I think there are a lot of algos at this level here. In the 4 hour. Like, you can see every time we come into this level, massive wicks. So yeah, I think this will be good. Similar, NJ, I like this here. Got the 2 hour. Yeah, I like this for sure. So yeah. Oh, and obviously Swiss franc yen. So 3 yen pairs. Obviously, I won't be going into all of these yen pairs, because it's like putting all your eggs in one basket. It's effectively risking 3% on the same trade idea. But yeah, this could be very nice for sure. For sure. 199 handle. Yeah, literally. So yeah, this is essentially what I am looking at for this week, technical wise. And that is the outlook, really. Not much else to add. As always, if you are interested in the platform we use, it is Cognito Updates. This platform here. These are all the features. I won't bore you. You all know. But yeah, obviously Cognito50 is the discount code. Give you 50% off. Obviously because you're watching the YouTube videos. And yeah, that is the outlook for this week sorted. Any questions, as always, drop them in the comments, drop them in the chat in the web app, and yeah, let's have a good week.